It's Monday morning. Say hello to markets and say hello to green color once again. It's a lot of green on the screen, guys. The breadth, that is looking absolutely phenomenal. The breadth, I think, is looking phenomenal. You've got Tata Motors, JSW Steel, SBI Life and HDFC Life. All of them are moving up in a uniform manner. You've got the advanced decline ratio, which is firmly in the green. You want to look at some stocks here, not that there were too many news makers over the weekend, but let's first start with some of the prominent names which always pop up when it comes to the interest of the trader. The first stock which right now is occupying a lot of center stage, I think, is Zomato. There's a Morgan Stanley report, there is a Kotak report, all of them now love the stock, and that is now getting reflected in the stock, 78.5. The second stock which is worth revisiting, is IEX. It's a stock where the bottom has been smashed after the new regulations which have come in, and IEX today is bouncing back, 125 rupees for IEX. Then you got India Cement. A lot of yes and no was there in India Cement. What will happen to cement prices, what will happen to coal prices, is there M&A around the corner, keeps on happening with the India Cement all the time. 229 rupees for India Cement. And then there's one stock where ValueQuest and Norgis and everybody is bought into it, and that is CMS. It's under cash management. They run your ATM. So next time if you're going to an ATM, remember CMS is one of the largest players. They will try and connect with the management also, but it's way below its offer price, did nothing. But the importance of cash in a country like India does not die. So what, 2000 rupee notes are going, 500 rupee notes are still in demand. It's done very well for itself, 31.5 in terms of, it's done very well for itself after the block deal, 315 rupees, up 8 rupees.
Right, couple of other stocks which are in focus, and I want to quickly bring up Go Fashion. The block trade was expected at a 5% discount. We've already seen in the pre-open rates how this is one stock which is under pressure, 5% lower as we speak right now. For Divi's Laurus Labs, weak export data for the month of May. TVS Motors, TVS Credit, remember, has raised about 480 crore rupees from Premji Investments. So that's another stock, TVS Motors, that is in focus this morning. That will just come up for you on your screens. Tata Steel, JSW Steel, positive first quarter negotiations with auto companies. And like I just highlighted, there are reports of price hikes coming in there. The Q1 contracts for HRC, CRC have been revised upwards. This also, of course, is going to weigh in on the RMC cost for auto majors. But that said, there's Ujjivan Small Finance Bank as well. The brokerage upgrades are pouring in post the analyst meet. So that's another stock which is in focus. And SBI Life, amidst the insurance data, the individual ERP has come in higher by 8.5% on a year-on-year basis. So that's really been the strongest of the lot amidst the insurance plays. Having said that, there's HDFC Life as well, wherein the May premiums have come in higher, 26%. Market share has seen a gain of about 181 basis points. So that's another stock which is in focus. Pidagad as well is in focus this morning. They're looking to raise about 288 crore rupees from small cap fund at 380 rupees per share. These stocks, of course, have been very, very buoyant of late. Cochin Shipyard as well, which has emerged as the lowest bidder to upgrade an Indian naval ship for a sizable 300 crore rupees. Cochin Shipyard gaps up by about 4.5% as we speak right now. Interglobe Aviation, they've expanded their code-share partnership with Turkish Airlines for now, the US. So this is a big foray that they are seeing. Interglobe Aviation, though, is pretty quiet right now in trade as we speak right now. So these are a couple of stocks which are in focus. And for TVS Motors, they're also looking to additionally acquire the 25% stake in SEMG as well. So that's another stock which is in focus. TVS Motors will just come up for you on your screens. But for the index per se, Kunal, it seems like quite an unimpressive start.
I think it's an okay start. We're still consolidating, and I think we'll probably consolidate for at least another few trading sessions. Till the time we trade above that 18,400 mark, it could be still position hold for the index longs, which we've created a couple of weeks back. Now, in terms of stock, I think United Spirits is something which looks very attractive. Last week, the stock came out of almost a 1 week consolidation, managed to show good strength on Friday's trading session. So I'm expecting strong follow-through move for United Spirits over the next couple of days.
All right, bullish on United Spirits. That's Kunal's first trade. Naresh, looking at the screen, what's looking appealing to you?
So that is BHEL. That's a stock which is shaping up for a breakout. Looks promising. Been a laggard in the capital goods space, could take leadership in the short term.
Kenneth Andrade joined just now. I haven't had him on the channel for a while, and it's good to see Kenneth back. Kenneth, how you been, my friend? Long time no see. You've been busy counting money, looks like. New fund, bull market. You've not been coming on the show.
Nothing much, nothing much. It's been quiet all around, and markets do help. Like I heard you say some time back, it's a reasonably good economy to be in at this, and I think it will sustain itself for a couple of quarters, if not a couple of years.
ये तो पहली बार है that fund managers are listening to television anchors.
Well, it works both ways sometimes.
Okay. So, in general, what do you make of this sudden turn in liquidity? Because for me, that really is the story of 2023. The way foreign institutional investors, our good old fair weather friends, who after selling and massively selling down in 2022 have made a roaring comeback. Do you think this is just the beginning of a multi-year turn when it comes to global money allocations to India?
So India has always been on the radar for a long period of time. Okay, and India has been sometimes a strategic trade and sometimes a long-term trade by foreigners. I think given where the economy is based and given lack of also options that are there available across the world, we will get a fair share of the larger allocations that are there. So I think what you see right now could be sustainable. But I don't understand their compulsions as to why they take money out and why they bring it. Of course, a lot has to do with what's happening in their home markets at various points in time. So they did take money off, and you saw what happened and you saw reasons why that emerged. I think a lot of those reasons have quieted down quite a bit, quite significantly. So you're back to the trade where emerging markets are getting back into their allocations, and India is one of the larger countries out there.
Though to turn contra in the market, because what we've seen is while the market optically may be at life highs, but a large gamut of heavyweights, so to speak, have not participated at all in the move.
Well, if you look at the marketplace, we're just about close to where we were in 2021. So there's been a fairly long consolidation that has taken place, right? And if you look at all companies that are there in the indices and also some of the top 500 companies in these indices, they are not cheap in terms of where valuations stand. So they are about 20 times to 25 times earnings. But while saying 20 to 25 times earnings, they are also at their best in terms of where their financials can be. Okay, so you're coming out of an environment where you have reasonably close to peak margins, peak profitability, and lowest debt on balance sheet. Okay, so to expect the same companies to do it all over again at this base, I think a lot of companies have the problem, and these are the large companies have a problem of reinvesting their capital on the ground, right? So I think that's where the challenges are. The big companies are struggling to reinvest capital. There's not enough opportunities on the ground to leverage the cycle forward, which is why I think, given valuations where inability to invest capital into larger projects, they will tend to be a little, should I say, cash flow yield kind of valuations rather than growth valuations.
Kenneth, I'm going to take the clock back. We had a conversation around financials, and you've said that, look, I don't like financials. And financials have done rather well for themselves. When we spoke to you that time, the cycle was different, interest rates were different. Now the cycle is different, interest rates are different. How are you approaching financials as a category? Because given the weightage of financials in a benchmark, it's hard for any fund manager to ignore it.
Okay. I mean, firstly, what's there in the benchmark has very little relevance to us, right? Because when we put money to work, we try to optimize return on capital employed of companies, irrespective of which industries they are in, right? And somewhere financials, or should I say a breadth of financials didn't fit the entire portfolio. Now, if you look at this, the environment where it is today, now, so just let me give you a statistic. I think the Nifty 500 companies, which is approximately 30% of our GDP, right? Their total debt on balance sheet, net debt on balance sheet, would be in the region of about 25 lakh crores, right? And our largest bank that is sitting there, which is the public sector State Bank of India, their total balance sheet size is about 55 lakh crores, right? So corporate India are under leveraged and they can't grow because they lack the opportunity to actually put in significantly large projects out there. And I think that's what the problem remains with the banking system, or I would say generally in all corporates. And so banks are available at some of the banks are available at nice valuations. Some of them are growing, but I think it's a stock pickers market rather than saying that financials is great. Okay, number 1, 2, 3, 4 probably did well. After that, it's a wide open basket, and it's really a stock pickers market. So indices wise, the banks have done well, but within those indices, you probably have 3 or 4 banks that have done extremely well, and they are the ones with the largest weightage in the index. Okay, so our views, you go stock picking there rather than try and own financials as an asset, financials as a basket, and you will come out okay.
Kenneth, I'm again looking at the Bloomberg data, what is available in the public domain, all cap strategy, one of your biggest schemes. There is, it's a very stock specific theme there. You've got Reddington, you've got Aurobindo Pharma, you've got Radico, you've got Tata Steel, you've got Global Spirits, and you've got IEX. So I can only see that as a theme there is liquor, and as a play there are metals. Let's understand, why do you like liquor? I mean, I'm not talking about liquor stocks. I'm not talking about any personal habits here, Kenneth. Only liquor stocks we are discussing. Let's me qualify it with a disclosure upfront. It's Monday morning.
So it's very stock specific. It's got nothing to do with the category. I think both those companies came in our portfolio when they were trading at low single digit kind of multiples, and the opportunity and the execution of both of them were extremely good. Okay, one is a manufacturer which has got tailwinds of ethanol, and the other one was premiumizing at a pace that we haven't seen in the past before. So I think that's where the two businesses came in, and they have been long-term holdings right now. So what you see right now is probably, in the case of Radico, it's been around for the last 5 years. In the case of Globus, it's been around for the last 3 years. But I've known both these companies since almost a decade or two, ever since they were listed. So it's got nothing to do with a category. They're just about simple execution businesses that are there. And when it comes to metals, I think we've come through the hump of balance sheet stress that is there on commodities. So I wouldn't say metals really, but commodities. And if commodities are this solvent and throwing out this kind of cash flow, I think they've got to be valued at a very different level over a period of time. So I think that's our context of holding these two businesses on the ground.
There is the sugar rush in the entire AI space, and Nvidia is one example of what is happening to the US technology sector. What happens in US market normally translates into a trend in India and into emerging markets. Now that AI is the go-to space for everybody, chip manufacturing is the space where everybody wants to have their presence. As a fund manager in India, what is the best way an Indian can bet on this entire multi-trillion-dollar AI theme?
I think you just sit back and watch, and then in the second round, pick up the companies that will survive the cycle. And that's how we look at it. We really are pressurized into catching the next best thing. And I think that's been our strategy. So we are very old school. We do not take a risk on something that we don't know how it will emerge. So we sit back and and in the second cycle, you will get companies which are large companies where valuations are great. But right now, I don't think we're going to chase some of those names or any of those names.
Yeah, and Interesting as well that Sam Altman on our network exclusive did say that to a certain extent AI may be replacing jobs, but of course not completely. What's your outlook then, Kenneth, when it comes to the entire earnings season that has gone by? Is there anything that has stood out?
Yes, plenty actually. It was difficult to find a company that lost money. I think that's a significant takeaway from last quarter from FY 2024-23 numbers. And even if you strip out the digital businesses, there were even fewer companies that made money. So I think that's a very good place to be in. Like in the last newsletter we had wrote to our investors, we said that India's got a problem of too much of equity today. In 2015, you step back to 2015, and India had too much of debt on the balance sheet. Today, we've got too much of equity on the balance sheet. So the good thing is, it's a super environment to be in. The negative part of this entire cycle is if you don't find too much of investment opportunities, then it will be a drag on our ROEs or our capital efficiency. So either India is going to pay out a lot of dividends, find opportunities to invest, or your ROEs are going down into a secular decline. So that's one takeaway. On the flip side, and that's the important piece to look at. Find an industry which is over leveraged anywhere in the world, okay, and find an Indian company that is under leveraged, okay, and that's a sweet spot to be in. Now, there is one space out there which is effectively pharmaceuticals, right, and that also in generic pharmaceuticals. If you look at most of the US companies out there, they are over leveraged. Some of them are already filing for bankruptcies. If you look at the Indian companies catering to that part of the world, they are cash on balance sheet. Now, I know it's not the best trade to be in, and it's not the most favorite trade to be in, but this seems to be something like IT businesses that were there in 2006, 7, 8. Right? The US companies got over leveraged in services, and the Indian companies went and took market share. So I think that's a very simple trade that's playing out. And that's how Indian corporates can use their balance sheets to go out and get the larger part of the global market share or global trade.
Okay, Kenneth, great to have you on the show today. Thank you so much for taking the time out and joining in with your thoughts.
Thank you very much.
Well, here's a programming note. Unlock a golden opportunity with ET Now on our 14th birthday. That's this Friday. Here's a gift for you. Participate in ET Now's Force of 14 contest and stand a chance to win 14 gold vouchers. On our 14th birthday, all that you have to do is through the week, watch ET Now, give us a missed call on 888-665-9272 and grab this golden chance. Of course, that we are asking is, what is ET Now's tagline? Is it Rise with India? Is it Pride of India? Or is it Ride with India? So tell us what your answers are and give us a missed call on that number on your screen.
ET Now has turned 14. And the golden celebration is on us. Watch ET Now on 12th to 16th June during the market hours from 9 a.m. to 12 noon and win exciting prizes. All you need to do is just answer one question every hour. To participate, give a missed call on 888-665-9273 and answer the question. 14 winners will stand a chance to win gold vouchers. It's raining gold with ET Now.
All right, Sandeep Tandon joins us. Let's talk markets, his new fund offering. What is he planning to buy in his new fund? How much money he's raised? Okay, what are we starting with, sir? How much money NFO? And so far, what's been the response? Let's start with it.
So, Nikunj, we are in the process of launching. We launched our cycle funds, and now we are launching a couple of thematic funds because it is based, as you know, we believe in market timing and we believe with thematic fund, which is generally perceived more risky. But if you can time the thematic fund, then you can generate extraordinary alpha in that. So we believe that that liquidity cycle has already bottomed out last year, November, December. risk appetite cycle should ideally bottom out between July to September. So we have been talking about a phenomena that we are coming closer to that event. And then everything start looking good for particularly for India perspective, irrespective of whatever last 1 month move we have seen. So once you're looking at the data points coming in your favor, then the probability of you making extraordinary money in these sectoral themes should be a good opportunity. That's the way we define our logic or thesis of launching multiple sectoral funds.
That's interesting. Sandeep, so tell us, when is the NFO closing? Give us some more details.
So this is a BFSI BFSI fund is there, which is more of a banking financial services. But the way we is closing on 14th of this month. The way we looking at banking is one anyway everybody can capitalize through various names. What we're trying to do differently is about the fintech aspect, because we believe technology is changing. So we are thinking when technology meets the trust. So that's the way we are defining the thesis of this fund, where we are trying to look an opportunity on the neo banking side, digital banking space, or anything related to a technology aspect which can enhance the BFI space. So those are the companies which we are targeting, and some of these new age companies have also corrected a lot. And maybe going forward, we might get some of these opportunity also, but that does not mean that we participate in a very expensive name. Some of the names are still very expensive. So it's an opportunity which we are looking at how well we can combine the digital banking or the normal banking along with the technology. That's the way the thesis of this fund.
Right, Sandeep. So, just wanted to understand from you in further detail in terms as to what has been, the underlying thought process as well as the overall theme for the fund.
See, the way we look at it that, we have been very vocal about that India is in a very unique situation. I have been talking about manufacturing as a very larger thesis. So we said this decade belongs to India, the half century belongs to India. With that background, you look at, obviously this is much larger perspective. Then we also try to look at the various cycles. So when we talk about cycle, then we specialize in looking at the quant analytic thesis, which we build by analyzing hundreds and thousands of years of data. So we have been talking about a volatility expansion phase between 2018 till 2023. What we said that it means this is the period where volatility will remain elevated. Now we are in the culmination phase of that, which means that in 2018 we expect 2023 the volatility will give you a last spike, okay, which means market can correct a bit, and then volatility will settle down for few years perspective. And that is the opportunity which we are trying to capture, that when volatility settled down. Today, what is the biggest challenge in last many years? Market has corrected also, market has rallied, but market has been very volatile. That has not kept the confidence of most of the investors because people are generally worried. So we believe that even the volatility cycle will actually peaked out by September. So we have said between June to September 2023 that cycle should peak out. It is very difficult to pinpoint exact dates, but we are closer to that event, and that's the reason we believe that once the volatility starts settling down and risk appetite also start inching up, and liquidity anyways in our favor, that could be a good combination for multiple sectors. So that's the reason this thesis of cycles funds or any sectoral fund which we want to launch, because this is so far we have only seen a big trend in the capital goods space. If you ask me, capital good and industrial is one area in last 2 years particularly the sectoral thesis has played out very well. I think now time is coming in this period we are looking at that multiple sector opportunity will re-emerge. And that's the area we want to capitalize instead of just looking at the Nifty or the frontline indices. I think this is the area where you generate extraordinary alpha in next few years.
So Sandeep, give some color on, given the theme of this NFO, which are the stocks or companies you think are best positioned to benefit out of this theme?
So as I said, when we talk about cycles theme in general, I think cycle, as I said, being a thematic fund, the cycles or the thematic fund, the advantage is that if you can time it better. So we are saying that once the volatility settle down, which we expect in next 1 quarter or higher side, once it settled down, it should lead to a multiple opportunity. So far, if you look at is the Nifty has been very skewed, Okay, as I said, last 1 year, it is largely the capital goods space has done well. So when we're talking about sectoral themes which keep emerging, so pharma is another area which is emerging. Telecom could be another area which is emerging. Metals is again a very beaten down name. That is another theme which is could lead to some opportunity. Textile is another area which is opportunity. Something maybe not technology on immediate basis, maybe down the line, maybe few months, that could be another area. Ideally, it should reach the neglected zone. It is now approaching that neglected zone. So is the case with some of the BFSI space also, where some of the stock has got into many like significantly overowned state, and they have been underperforming for a while now. So I think I expect in this correction, there could be some give up in these name, and that could lead to buying opportunities. So there are multiple themes which we are looking at over a period of next 1 quarter.
Sandeep, you've raised what, $1.5 billion in this NFO so far?
Our total AUM is around $3 billion. Okay. This is just, it's open, last cycle's fund we raised 180 odd crores. Okay. See, Nikunj, we are a smaller, a very young mutual fund. So no question of raising $1.5 billion. Total AUM is around $3 billion.
Beg your pardon. I mean, total you have $3 billion. How much is debt?
97% is equity.
Okay. Great. And your returns have been how much in 3 years?
See, last 1 quarter or so, we relatively some amount underperformance because we have been cautious on the market. But in last 3 years perspective, we are the top of the chart in terms of all the categories which we operate. And what is more interested in the outperformance is one aspect which we are very happy and satisfied is that what we generated superior risk-adjusted returns. So if you look at the risk-adjusted return, we are the best in the industry.
You had a lot of Adani group of stocks, and we've discussed
at some point
this.
in time, yes.
Have you sold them, and would you be looking at buying them again, or you want to be avoiding Adani group of stocks as a category now?
See, I tell you, we don't have any love or hate relationship, any stock or sector. That's the way when we talk about very dynamic style of money management. So we bought Adani Enterprise as a more of an index play. So last year when it became part of the index, somewhere in mid-October, we exited Adani Enterprise. But we are holding Port and Ambuja. But we bought Ambuja when it was not part of Adani group of the companies. It was an MNC company in those days. Okay. Yes, purely from a risk management perspective, we have pruned down or rather exited both Port and Ambuja in January. But what is very important to understand is that risk management is very important. We don't have any emotional attachment with any sector or stock or any group. Okay, so when we see data points are changing, we believe this. The hype which was getting built or the perception which was getting built has somewhere dented, and that takes time to rebuild. So we are not as such negative. If this is an opportunity, we are not very reluctant or allergic to any group, but see at that point in time. But as of now, our data points are not that constructive to rebuild the exposure from the current levels.
Okay. Sandeep, let me divide the market in two parts. One, where there is excitement and little value left, and B, where there is no excitement and there is a lot of value left. Defense is one category where there is excitement and no value left. But similarly, if I look at, let's say, NBFCs, if I look at, good old AMC stocks or insurance stocks, there is no excitement, but there is a lot of value. Let's address both these themes, defense and insurance and AMCs.
So I completely agree, defense is one area which I think good amount of euphoria we have seen, and I am also very skeptical at the current level because purely from a valuation perspective does not give. And these are relatively illiquid. If you look at even from a liquidity analytics point of view, we have seen extraordinary liquidity in these names and people are chasing these things. So some amount of risk appetite is also high. So could be I will say a deadly combination that one should not look at these names on the current level. So that does not mean we are advising any shorting or exiting, but we are not going to be buyer at these levels. Now, if you look at the AMC aspect, I think the recent SEBI circular is still not very clear what is the final outcome. So one has to look at, and I would like to wait and watch and say what is the outcome, okay? Because whatever guidelines have come, if it is adopted in this manner, then I think the entire AMC business will be T-rated, so the downside is much more. Okay, but it's too early and too premature to comment on that, because once these guidelines, because I think industry has represented, we have also represented the pros and cons for whatever is coming, because we are very vocal. If this is implemented in this manner, there will be good amount of arbitrage opportunity, because you look at one side, mutual funds are asked that you have to pay you have to be taking care of the brokerage and STT both. Okay, and then you look at as a trader, because the whole life we have done good amount of arbitrage business. If I'm a large trader, then I will trade through mutual fund, because neither I have to pay any STT nor I have to pay any brokerage. It's a great arbitrage opportunity will available. I think the balance sheet of the many mutual fund will be wiped out. It is implemented in this manner. So one area I think a lot of people have not understood, because if this implemented in this manner, create massive arbitrage opportunity for the trading clients at the cost of mutual fund AMC. They will be making money. So investor is not going to getting benefit out of it. Rather, only trading mindset people will getting huge benefit out of the proposal. So I like to wait and watch and see how it unfolds.
So if somebody says, look, I've really enjoyed this interaction of Sandeep Tandon with ET Now, I love the way he's invested. Here's my big fat check from a family office. If so, hypothetically, somebody gives you a 100 crore check, which you're free to invest whichever way you want, but you have to double the money in 3 to 4 years. How would you invest?
So I said that.
And looking at your track record, that is easy. Bhai, track record to hai.
Fair point. But Nukuj, as I said that for the family office, the risk appetite is far higher than the real retail investor. And as you clearly defined, they have horizon for let's say 5-year horizon. It's a good horizon one should have. I think sectoral funds will give you the best return. That's one of the logic which we talked about. It's not about since we have launched these funds, so I'm talking about. That's not our mindset. I'm very candid and very vocal about my views, because it's a data-driven view which we try to give rather than saying this is my personal biases in any manner. I think sectoral themes. So if you say that this decade belongs to India, once this volatility cycle settled down, I think many more thematic opportunity will emerge in next few years perspective or next few quarters perspective. I think thematic is the one area. If somebody wants to look at the concentrated bet, I think time is now coming. So relatively more apt time to build the more concentrated bets rather than having a very well diversified portfolio. So that's the advice which I like to give.
Okay. Sandeep Tandon, appreciate your time and thank you so very much for joining us. Let's take a break with the news that we are 17 points higher on the Nifty, but nowhere close to 18,800. So all-time high, I think it'll have to wait. 10 days now and we've been in this range, getting kicked here and there, but the range actually is not large. It's about 200 points, and a 200-point range is something which is just a one day's work. One good global Q, one US inflation data, a little bit of help from FOMC. I really hope it happens this week. Let's take a break, but we've got a full house. We've got views coming in from none other than Aadhar Poonawalla on what their plans are for Pune, Pune FinCorp. And then Mr. Dinesh Khara, why does he feel that SBI is due for a salsa dance?
Welcome back. Flat for the index around the 18,580 mark, and for the broader markets, but it's a small cap index that's flexing its muscles. Let's get you that special then, and NBFCs have been on a tear off late as the market remains bullish within the space. In an exclusive chat with my colleague Ajay Sharma, the top bosses at Poonawalla FinCorp shared their roadmap for growth, saying that they remain well capitalized and will be able to achieve their targets. Here's an excerpt of that conversation.
This is a very special interaction today we are bringing for you from a group which has done some phenomenal work in the last couple of decades in the area of medicine and vaccines during the time of COVID, not only for the country, but also for the world. But today, the interaction is focused about their scaling up of their financial services business. I'm talking about Poonawalla FinCorp, and I'm right here at the headquarters of Poonawalla FinCorp in Pune, in conversation with Aadhar Poonawalla, who's joining me this morning. Aadhar, thank you very much for your time.
Pleasure to be with you.
So I've always wanted to talk to you in detail about Poonawalla FinCorp. Briefly, we've chatted about it. When you were really acquiring Magma FinCorp, till now, so the journey of taking that step, people questioned you that you've done phenomenal work in medicine, why financial services now? And now that the numbers are coming in, Talk to us about how that decision was made, the journey so far, and are you satisfied the way things are shaping up?
That's a good question. You know, when we acquired the group 2 years ago, people were quite skeptical. Why am I diversifying into something that is totally new or different to us? But, you know, the financial services is something that I always wanted to get into. I just didn't know and have the right platform to be able to scale up. When we looked at this group 2 years ago, we felt that this would give us a 5-year leapfrog into the financial services with the branches they had, the team they had. Of course, we've come a long way since then and rejigged all of that and, you know, changed the team. We've reduced branches, we've gone more digital. And we'll talk about that. But the idea was that India, the way it's growing, the financial services is a very fundamental part and a backbone of you know, being able to help and support everyone's dreams and aspirations. So to grow with India, with the growth story, we felt that the financial services sector is something that we had to look at, and that's why we went into it.
So Adar, you know, now as the company stands, it's pretty strong in terms of balance sheet, well capitalized. Numbers are, you know, talking for themselves. What's the big picture plan here? You want to scale it up into a full services, financial services powerhouse backed by fintech. Talk to us, give us some color on how do you want to scale it up?
Well, right now I've been focusing on, you know, becoming efficient and profitable. You've seen our profits grow quite well, and it's more than 500 crores the last year ending. And, you know, we started off with a loss of 600 crores. So apart from rejigging the team, the products, right now it's mainly into loans, different types of loans, of course. We're thinking about having an app and, you know, on the payment side, going more digital as well, along with, you know, collections, which is now 100%, you know, digital collections. There's no physical collections like it was when we took over. So a lot of changes. And, well, we'll see what other products we want to get into. But right now, I think focusing on loans will be the primary objective. And of course, small ticket loans. We're not talking about going into crores of rupees with real estate developers and infrastructure loans. We're talking about, you know, going up to 50 lakhs, 1 crore or whatever, if they're secured sort of loans. And as you know, with the housing business, which we have now sold to TPG, and we got the approval from RBI also, that will help us to focus more on the NBFC business. And you know, the housing business is something we said it's better that someone else looks at that.
Sure.
And look, the cash that we're getting also, as you rightly said, has really added to the capitalization of the company. You know, the net worth is going to be 8,000-9,000 crores after the taxes are paid for this transaction. And we're hardly, you know, 1.5 times levered. So
the scope for
the scope over the next 3 to 4 years, again, allows us to grow without having to raise any capital. We can easily reach an AUM, you know, 40 to 50,000 crores in that time span, the way we're growing. And if you assume, you know, 30 to 40%, which is a good growth rate, it's not too much. You don't want to grow a finance company too fast because, you know, then you might make a few mistakes and take too many risks. So keeping that in mind, I think, you know, over the next 4 to 5 years, we probably won't even need to raise capital.
Now we take the discussion forward with the MD and CEO of Poonawalla FinCorp, Abhay Buttada, the guy who is under whose leadership Poonawalla FinCorp and the financial services ambitions of the Poonawalla family are going ahead. Abhay, thank you very much for joining us today.
Thank you, Ajay.
So Abhay, I want to understand from you, and market also wants to know, what are the key differentiating points in your products at your company, which will be, you know, your company or Poonawalla FinCorp, which you are leading, will be different than other NBFCs or even other lenders, including some of the banks. How are you going to create that differentiating factor?
Very good question. I think we have a unique positioning in the market. Despite of we are into NBFC sector, the segment which we are targeting is one notch above the segment of what the sector is targeting. We target 700 plus CIBIL customers, formal income segment. We get a lot of data points, those who are paying GST on time, TDS on time, lot of other digital footprint we get PDF banking, and most of our product except loan against property, they are 100% digital end to end. Only in pre-owned car you require certain signature on RTI hypothecation form. Otherwise entire agreements are digital only. So major differences is a customer centric approach wherein we offer zero prepayment, we offer lesser rate. We want to eliminate money lending in a big way. With that thought in the mind, I think the customers are very happy. Customer stickiness, loyalty is very important in a longer run. So we are able to offer a combination of Ajaya, the fintech, NBFC and bank. Why I'm saying this? Because fintech, in terms of what you need is a user experience. So 100% digital sourcing. Then what you need is a practical approach, cash flow based lending. So we behave like an NBFC. We understand. We have done. We have completed 2 cycles, 3 years of TAP, 2 years of Punala Finance, here 2 years. So we have unsecured, we have completed 2 cycles, which very few people are aware about the past history of running this to NBFC. And why I'm saying bank? Because we behave like a bank, we have creating a structure like a bank, we are targeting customer of a bank. Because of the low OPEX, because of the less cost of fund, we are able to target that segment. We do early write-off, so there is a pressure at the time of onboarding itself. So it's like credit by invitation. And on the basis of our past experience, we are confident to maintaining the good asset quality.
You spoke about fintech and digital. Your experience prior with digital and technology. How are you building all of that into the business model of this company? And Adar was also talking about how this company is likely to evolve into a full-scale fintech going forward. What are your thoughts?
So basically, from TAP to Punala Finance, we have developed CRM. And we have developed LOS, LMS, collection and lot of other softwares. On the basis of that, I think data-driven lending, what we are talking about, everybody is talking about nowadays. I think we have got good experience into that. And on the basis of that, I think the going further, we will evolve this into a full-fledged fintech in terms of, because we have a very strong risk management, we have a collection infrastructure, we get a lot of digital footprints, and over and above that, in terms of WhatsApp lending, in terms of servicing of the customer through WhatsApp. And if you talk about the app, so we are launching a super app wherein you will get not only borrowing but a lot of other value added services, payments and so many other things, so that you will get one-stop solution for everything. So I think going further, I think we'll not talk about tech, we'll talk about the high tech.
Interesting. Not only tech but high tech. We understand that you're likely to receive the proceeds of the transaction very soon, the 5,000 crore odd, which will also improve your net worth a whole lot as a company. Close to 9,000, 9,500 is what we understand it is. When is that likely to come? How will it improve and what will you do with that money? There is also some talk that probably you'll utilize it for buying out other companies. Is that a possibility as well?
I think whatever long-term guidance we have given of 35 to 40% growth. So over a period of next 5-6 years, if we are not raising any primary capital, the kind of leverage which is less than 2 we have, and with this 3,900 crore and pre-tax will be closer to approximate 3,000 plus crore. So that will get added to the net worth. But I think we will continue with this capital. Right now we have a good team and technology. We are able to scale up. We are doing more than 2,000 crore per month of disbursement. So I don't think so. At least for next 2-3 years, we are not looking for any kind of inorganic opportunity. And we will continue with this capital and it will require for the further growth.
So Abhay, the company has come so far with the numbers they are. At this base, what are the kind of growth possibilities do you see for the company and also the space you are operating in?
See, basically, if you see last quarter, our AUM was 16,143 crore. So from 16,000 to 1 lakh crore, there are very few NBFCs are there. So we have a huge opportunity. If you see the total addressable market on the consumer side, on the MSME side, even though we are targeting a credit tested customer formal income segment, but still considering 1.5 crore plus GST user base, ever sir 42 crore of bureau base, a live database of bureau is almost 20 to 23 crore. So considering that, we have a diversification of products, secured, unsecured. So 35 to 40% we are confident for over the next period of 4 to 5 years. We don't see any problem because the base is very low and total addressable market, if you see, huge opportunities there. And I believe the credit growth will be very good over a period of next 7 to 10 years. So I think we don't see any problem for next 5 to 7 years to maintaining that growth with, of course, maintaining the good asset quality also.
And Abhay, though we talk numbers with you every time quarterly results are out, but directionally, the kind of NIM and ROA structured kind of growth you see from here on, also with the point that your legacy book at Magma is actually being run down, right? So where do you see the direction of NIM and your ROAs from here on?
So in the recent investor call also, we always maintain that on a steady state basis, NIM we will be able to maintain above 10 on a going further. And if you talk about the ROA, anything between 4 to 4.5%, but on a steady state basis, we'll be able to maintain above 4%.
All right, Abhay, thank you so much for your time today.
Thank you.
Well, you can catch that entire conversation later on ET Now. But unlock a golden opportunity with us on our 14th birthday. That's this Friday. Here's a gift for you. Participate in ET Now's Force of 14 contest and stand a chance to win 14 gold vouchers on our 14th birthday. And all you have to do is watch ET Now through the week. Give us a missed call on 888-665-9272 and grab a golden chance. And now on to our second question. When was ET Now launched? Was it 10th May 2008? Was it 17th June 2009? Or was it 19th July 2009? Send us your answers on the number mentioned on the screen.
ET Now has turned 14 and the golden celebration is on us. Watch ET Now on 12th to 16th June during the market hours from 9 a.m. to 12 noon and win exciting prizes. All you need to do is just answer one question every hour. To participate, give a missed call on 888-665-9273 and answer the question. 14 winners will stand a chance to win gold vouchers. It's raining gold with ET Now.
All right. I'm just going to shift gears, and Navneet Chell, partner with Bain & Company, joins us now. And they're talking about a powerful report of how India is going to be strewn $1 trillion economy, or $1 trillion digital economy by 2030. So Navneet, good morning. Thank you for joining us. India's current GDP is about 3 trillion. I'm just using that for benchmarking purposes. Your view is that large part of the future growth, where India will move from 3 trillion to $5 trillion, will be driven by the digital economy. What is your definition of digital economy, and what gives you the confidence that the digital economy right now, which is about 250 to 300 billion, could actually be $1 trillion in less than 10 years?
Yeah. So Nikunj, we are defining the digital economy as sectors that are powered by the internet. Largely consumer-facing sectors, but also includes any B2B e-commerce activity or SaaS. I think the reason we are very confident of this economy unlocking $1 trillion for the GDP is actually a confluence of three factors. I think we are interestingly at a point which is a bit of an inflection for the digital economy. The first most important factor that's playing out is actually an unprecedented digital consumption unlock that's happening. We do expect the GDP per capita to more than double by 2030, which is largely going to be led by consumption. 700 million internet users in the country with time spent online well ahead of China and already inching closer to US averages. So in some senses, the Haath Mein smartphone is now accompanied by Jeb Mein Paisa. And I think that combination is what has led to a dramatic shift in online transactors. We define these as people who are not just online for consuming video content or browsing social media, but are actually making purchases online. This number was 10 to 15% 5 years ago of the total internet users in the country. We now have about 30 to 35% of the total internet users in the country, the 700 million I spoke about, who are now transacting online. So both these savvy digital Indian users are going to actually spend more online as they premiumize, as they get exposed to new products, new services. We also expect more penetration in the internet user base itself. So both of those coming together, I think, will truly unlock at least the B2C digital economy. The other factor that's also played a very critical role is India's stack. I think India's figured out a way to build large digital public goods at a very different scale from the rest of the world. UP has perhaps been the largest innovation of the last decade, perhaps globally. So as ONDC, as OK and UHI find their feet and use cases, I think the foundational layer is so well laid that it can power innovation at a very, very breathtaking speed. That is the second reason we believe that the digital economy will take off as never before. And the last aspect is actually the business ecosystem coming together and the role that businesses will play. With consumer demand lined up, with the foundational elements through India Stack coming through, I think all kinds of businesses are already making strides in building a digital core. We also believe it will be more inclusive phenomena, not just driven by the startups, for instance. The first generation of success stories there have definitely led to a more mature, wizened, measured startups ecosystem, and that will continue to thrive. But it has also spurred large traditional businesses to reinvent themselves. So when the sourcing and distribution advantages of these large players meets the technology backbone that they are able.
I have a very basic, simple question. A lot of digital growth has taken care has happened in India largely because of the cost of capital. A Paytm or a Zomato would have not happened if the interest rates were so benign globally. Now we are in a very different regime. If interest rates are going to be normalizing, don't you think a lot of digital growth automatically could take a backseat, largely because there is no free money available in the world?
We don't think so, actually. We believe, and we spoke to a bunch of investors as part of this work, the confidence on the India story continues to be very, very high. And I think as we think about the availability of capital, there are two aspects maybe to keep in mind, right? The first is that we need to take a through cycle view of what we are looking at right now, which is the so-called funding crunch. And as the veterans in the system will tell you, both founders, investors alike, I think the greed fear cycles are a part and parcel of venture capital and startup world. So the big difference this time probably is just the magnitude of the cycle, given we are coming off the mother of all bull markets. Of course, a zero interest regime was bound to have produced some excesses, and some of those excesses are getting purged now. We've seen this, play out before. If you think about the financial crisis 15 years ago or the dot-com wave, in some senses, I think it doesn't change the overall trend line. There are world-class companies being built out of India. I think that will not change. And if you think about, for instance, even 2022 is down 30% from 2021 in terms of capital flows. 23 is likely to be further down. But we saw the same thing, for instance, happen in 2012 as well, when VC funding fell by a similar magnitude. But what do we remember of that phase if you think about it now? It also gave birth to Flipkart, many, a Myntra, Freecharge, and the likes. So in some senses, I think companies will be born that will actually now be in a resource-constrained environment, will probably innovate better, will have more robust fundamentals in terms of how they scale. And I think that phenomena is not something that we believe will get impacted. There is capital availability. It will get redirected to higher quality outcomes. And hence, I think the overall, if you think about the macro picture, India continues to be in decent shape. We are still the fastest growing major economy. We are going to likely continue to be in that spot. And there are so many tailwinds in play as well, right? The demographic dividend, the geopolitical landscape, high quality talent pool, I think, and a functioning democracy, and so on and so forth. So if there was a country likely to weather the near-term storm better than others, I think it'll probably be us.
Sure. Just a continuation of that point, Navneet, clearly, like you're saying, with faster adoption of the internet, the T+2 and beyond cities are expected to see the strong growth. But tell me, which sectors have you seen a better adoption when it comes to digital at large?
I think all sectors, frankly, have seen that, growth play out. But in particular, if I had to call out a few, I think e-commerce has done phenomenally well. 220 million online shoppers in the e-commerce space today, adding about 40 million year on year. And what's been very interesting is that more than 60% of that new shopper growth has actually come from smaller towns. So what that started to do is unlock a lot more penetration. Like I said, I think a lot of the internet users are now moving to becoming transactors as well. So this 220 million in our estimate, for instance, is going to be 550 million consumer base by 2030. So as that penetration plays out, as people get exposed to more digital goods and services that they can spend money on, I think e-commerce is one area that has seen much more, larger, widespread phenomena in terms of consumer base expansion. And I think that combined with the fact that as they get exposed to more categories, as they premiumize with more discretionary spend at their disposal, I think both of those will lead to some phenomenal growth still to be had in the B2C commerce space. What's additionally been interesting is to see, more inclusive features. When you think about, for instance, vernacular and voice searches, which are starting to take off, they are making all the difference to the online user experience for people in T2 and beyond. And I think that is also further helping boost a lot more spend coming from those areas in these sectors. Online travel, for instance, is another one. I think there's been gradual recovery so far, but there is still a lot more that has to be had. It's one of the few sectors that has large penetration. 75 million flights booked last year online, 100 million hotel rooms booked online. These are large numbers. And it's a sector that has seen almost 40 to 45% penetration of GMV actually sitting in the online world. So I think all of these are indicative of the fact that there is widespread growth that most sectors are seeing. EdTech is another one. I think very large base of users that are leveraging online education services.
Right. Navneet was interviewing Rajan Anandan over the weekend, and he said that the biggest disruptor, without a doubt, is going to be AI. And I just want to understand what your outlook is in terms of organization and startups really adopting to rewiring themselves to this. Is there going to be that fear as well of a replacement of jobs or roles to a certain extent?
Well, I'm not an expert on the topic, although I did study computer science back in the day. So, just that caveat as I talk through this. I think the way we look at, AI is interestingly how maybe Andrew put it, the Coursera CEO, that it's the new electricity in some ways. And much like electricity transformed multiple industries in the past, I think AI is doing that already. So in some senses, a lot of big tech strategies pivoting to AI being at the very core. So generative AI is going to be the birthplace of multiple large companies that are, already being born. So in some senses, it's inevitable that it will change everything in most industries. So whether you're on the right side or the wrong side of that change depends entirely on how different companies will react to the change. For instance, there are companies already making use of AI to write code 5x faster and cheaper. And it may turn out differently and a lot more, positive in terms of the outcomes that they will see as a result. The report also does talk about many of the use cases that, companies have already started to leverage. Customized recommendations, promotions, rewards are a whole host of, how do you optimize the consumer journey leveraging AI. Customer service is also fundamentally changing as well. So there's definitely a lot of thinking and innovation happening with AI at the core, and we will definitely see organizations reinventing themselves in light of this.
All right, good to have you on board. Thanks so much for giving us a glimpse as to what the outlook is when it comes to digital India and the opportunities. Let's slip into a very quick break then, right here on the show. Be right back with Chartbusters.